What if you could make a brilliant financial move, even if you expect your tax rate to be lower in retirement? New research from investment giant Vanguard suggests it's not only possible, but it may be the smartest decision you make during a market crash. This isn't just theory. We're talking about a specific powerful strategy called a Roth conversion. It's the process of moving money from a pre-tax retirement account, like your traditional IRA or 401k, into a post-tax Roth IRA. The catch? You have to pay income tax on the entire amount you move, right now, in the year you do it. This sounds painful, and it can be. But when markets are in turmoil, that pain can lead to an incredible, lifelong financial gain. Understanding this paradox is the key to turning a crisis into a massive tax-saving opportunity. Think of your traditional IRA as containing a hidden liability. Every dollar in that account is co-owned by you and the government. You own the principal, but they own a piece of it in the form of future taxes. You just don't know how big their piece will be yet. It could be 22%, 24%, maybe even 37% or more, depending on future tax laws and your retirement income. That pre-tax account isn't all yours. It's a tax time bomb, ticking away, waiting to go off when you start taking withdrawals in retirement. The Roth conversion is how you defuse that bomb on your own terms. So why is a market crash the perfect moment to defuse it? Because a crash puts your tax bill on sale. Imagine your traditional IRA holds 1,000 shares of an index fund. Before the crash, the fund was at $100 a share, making your account worth $100,000. To convert it all, you'd add $100,000 to your income and pay taxes on that amount. But after a 30% market crash, the fund is now at $70 a share. Your account is worth $70,000. You still own the exact same 1,000 shares, the same piece of the underlying companies. But now, you can convert all 1,000 shares and only pay tax on $70,000. You're moving the same assets, but triggering a 30% smaller tax liability. This isn't market timing. It's tax timing. Here's where the deep psychology comes in. Your brain is hardwired to prevent you from doing this. The concept of loss aversion, identified by behavioral economists, shows that the pain of a loss feels roughly twice as powerful as the pleasure of an equivalent gain. When you look at your portfolio during a crash, your brain screams, "Danger! I've lost money! Freeze! Don't do anything!" It focuses on the paper loss, the drop from the previous high. But this emotional reaction blinds you to the strategic opportunity. The smart move is to override that instinct, reframe the situation not as a loss, but as a discount, and take calculated action precisely when it feels the most uncomfortable. The mechanics of the conversion matter immensely, especially during volatility. You want to perform what's called an in-kind conversion. This means you instruct your brokerage to move the actual shares of your funds directly from the traditional IRA to the Roth IRA. The alternative is selling the shares, waiting for the cash to settle, moving the cash, and then rebuying the shares in the Roth account. This cash-out and rebuy method can be disastrous. In the few days it takes for the cash to transfer, the market could rebound sharply, and you'd miss out on that initial surge, forcing you to buy back your shares at a higher price. An in-kind transfer ensures you remain invested throughout the entire process, capturing every single moment of the eventual recovery. And this is where the magic truly happens. The rebound. Once those shares are in your Roth IRA, every single dollar of growth from the market bottom for the rest of your life is completely and permanently tax-free. Let's return to our example. You converted 1,000 shares when they were worth $70,000. The market recovers, and a year later they're back to being worth $100,000. That's a $30,000 gain. In a traditional IRA, that gain would still be taxable upon withdrawal. But in your Roth, it's yours. Free and clear. 10 years later, the shares are worth $250,000. That's a $180,000 gain, all tax-free. You paid a one-time tax on the depressed value to unlock a lifetime of tax-free compounding on the full recovered value. Now, let's address the tax bill itself. Paying it is a crucial piece of the puzzle. The absolute best-case scenario is to pay the conversion tax with money from a non-retirement account, like a checking or brokerage account. Why? Because using money from the IRA itself to pay the tax reduces the amount that gets into the Roth to start compounding tax-free. It's like taking a small bite out of the seed you're about to plant. If you convert $70,000 and are in the 24% bracket, the tax is $16,800. If you pay that from your checking account, the full $70,000 starts working for you inside the Roth. If you withhold it from the conversion, only $53,200 makes it in. That lost $16,800 could have grown into a huge tax-free sum over the next few decades. You don't have to convert your entire account at once. In fact, for most people, that would be a terrible idea, as it could push you into a much higher tax bracket for the year. The more strategic approach is to perform partial conversions. Look at the tax brackets like a series of jars you can fill. Your goal is to convert just enough each year to fill up your current marginal tax bracket without spilling over into the next, more expensive one. For example, if you have $30,000 of room left in the 22% bracket before you hit the 24% bracket, you could convert exactly $30,000. By doing this over several years, especially during market downturns, you can systematically move your money to a Roth at a controlled, predictable tax rate. There's another powerful, long-term benefit. Roth IRAs have no required minimum distributions, or RMDs, for the original owner. Starting in your 70s, the government forces you to withdraw money from your traditional IRAs and 401ks every year, and you must pay income tax on those withdrawals, whether you need the money or not. These RMDs can be substantial, pushing you into a higher tax bracket in retirement and causing a tax drag on your Social Security benefits. By converting to a Roth, you eliminate this problem entirely. The money can grow tax-free for your entire lifetime, untouched if you don't need it. This gives you ultimate flexibility and makes the Roth a far superior vehicle for passing wealth to your heirs. For advanced strategists, there's a synergy move. If you have a taxable brokerage account, a market crash is also the perfect time for tax loss harvesting. This means selling investments that have lost value to realize a capital loss. You can use these losses to offset capital gains elsewhere and up to $3,000 per year against your ordinary income. Now, here's the combo. You use tax loss harvesting to lower your overall income for the year. This creates more room in your lower tax brackets, allowing you to perform a Roth conversion at an even cheaper rate. You're effectively using losses in one account to subsidize the tax bill for a strategic gain in another. It's a way of turning lemons from one part of your portfolio into lemonade for another. The evidence for this strategy isn't just theoretical, it's written in historical data. A 2018 study by the Joint Committee on Taxation analyzed what happened after the 2008 financial crisis. In 2010, income limits for Roth conversions were temporarily removed, just as markets were beginning a tentative recovery. The result? The total amount of money converted to Roth IRAs surged by over 700% in a single year. Investors who understood the math pounced on the opportunity to convert their battered portfolios at a massive tax discount. However, the same study found that about 31% of people who could have optimized their conversions made the wrong choice, highlighting just how difficult it is to act rationally when your emotions are running high. The growing popularity of this strategy is undeniable. Data from the Investment Company Institute shows a clear trend. In 2019, taxpayers completed nearly 900,000 Roth conversions, totaling around $27 billion. This was roughly double the number of conversions from just 5 years earlier in 2014. This isn't a niche trick for the ultra-wealthy anymore. It's becoming a mainstream planning tool for savvy investors who recognize the long-term power of tax-free growth. The question is no longer if a Roth conversion makes sense, but when and how to execute it most effectively. And the data consistently points to periods of market distress as the prime moment to act. Now we arrive at the biggest myth of all, the one that stops most people from even considering this. The old rule of thumb was, only convert if you're certain your tax rate will be higher in retirement. This feels intuitive, but it's a massive oversimplification. Groundbreaking 2024 research from Vanguard introduces a more sophisticated metric called the break-even tax rate, or BTR. This calculation determines the future tax rate at which you'd be financially indifferent between converting or not. And what their model shows is stunning. In many common scenarios, especially if you have a long-time horizon and can pay the tax from outside funds, your break-even tax rate is actually lower than your current tax rate. Let's break that down because it's profoundly important. This means you could be in the 24% tax bracket today, expect to be in the 22% bracket in retirement, and a Roth conversion could still make you wealthier in the long run. How is this possible? The BTR model accounts for the tax drag on the money you use to pay the conversion tax. If you pay the tax with non-retirement funds, that money would have grown and been taxed on its own. By using it to prepay the tax on your retirement funds, you are freeing a much larger sum of money, your entire converted IRA, to grow tax-free forever. The tax-free compounding is so powerful that over decades, it can overcome the initial hurdle of a slightly lower future tax rate. A 2023 study in the Journal of Financial Planning confirmed this, showing that a long time horizon is a dominant factor. Another common objection is, this feels like market timing, and I've been told never to time the market. This is a misunderstanding of the goal. You are not trying to predict the absolute bottom of the crash to the day or the hour. That's impossible. Instead, you are engaging in tax timing. You are simply acknowledging the objective reality that your portfolio's valuation is significantly lower than it was a few months ago. The sale on your tax bill is real, whether the market drops another 10% or not. The goal isn't to be perfect, it's to be directionally correct. By converting when the market is down 20, 30, or 40% from its peak, you are mathematically locking in a tax advantage, regardless of what happens tomorrow. The final major fear is, what if I convert and the market drops even further? This is a valid concern, especially since the Tax Cuts and Jobs Act of 2017 made Roth conversions irreversible. You can no longer undo a conversion if it turns out to be poorly timed. But there's a powerful strategy to mitigate this risk: laddering your conversions. Instead of converting a single lump sum, you break it up into smaller chunks and convert periodically throughout the downturn. You might convert a piece in October, another in November, and another in December. This is a form of dollar-cost averaging for your tax bill. You'll get some shares at one price, some at another, smoothing out your tax basis and reducing the risk of converting everything at a temporary peak before another leg down. So, when you see the markets filled with fear and headlines screaming about a crash, your programming will tell you to run and hide. But now you see the matrix. You see the downturn not as a threat to your wealth, but as a rare window of opportunity to fundamentally restructure your financial future. It's a chance to trade a moment of calculated discomfort for decades of tax-free growth. By understanding the mechanics, overcoming your innate biases, and applying a data-driven strategy, you can turn the market's biggest panic into your most powerful personal finance move. Now, you know how to reframe a market crash from a source of fear into a strategic tax advantage.